Welcome to The Debate. We are looking today at one of the most compelling paradoxes in the current market, the state of Apple. Here you have a company with a market cap north of $3 trillion, yet the stock is seeing a noticeable dip. It's trading around the $278 mark, and this trend has raised a really fundamental, critical question about the company's path forward.
Right. And the question is really this. Does this slowdown reflect a necessary stabilization phase? Something driven by immense internal strength that actually makes this dip an opportunity? Or, on the other hand, do the documented risks, and I'm thinking about the slowing product growth, signal a fundamental warning sign?
Exactly. And I'm going to argue that Apple isn't faltering. It is transitioning into a stable, highly reliable structure. I see this dip as a temporary and, frankly, healthy correction for a company of this sheer scale.
And I'll be taking the other side. While the scale is undeniable, I believe this dip reflects serious structural risks that the market is finally starting to price in correctly. I think the stability you're describing looks more like a slow-moving target than a fortress. To me, it's a critical warning, not just a pause for breath.
Look, the market is fundamentally misinterpreting the optics of slow growth. People are constantly comparing Apple to these high-speed, hyper-growth companies like NVIDIA, and that comparison is just completely misleading. Apple is a mature company now. It's almost a utility company wrapped in a luxury brand. My position is it's really built on foundational strengths that establish an unbeatable floor, ensuring sustainability far beyond just one volatile growth cycle. First, and this is critical, services revenue. iCloud, Apple Music, the App Store, that's growing consistently, providing this recurring income with vastly superior margins. Second, the user ecosystem is basically locked in due to, let's call it, unbeatable brand loyalty. iPhone users tend to stay iPhone users. And finally, their massive, unparalleled cash reserves. That provides insulation against economic storms and, real strategic flexibility. This isn't a crisis. It's a company perfecting its operational model.
I acknowledge the power of those 3 points: services, loyalty, and cash. They are absolutely real. But I have to push back on the idea that those strengths somehow mitigate the core problem, which is the failure of the historical engine. The growth model is faltering precisely where it counts the most: the iPhone. The source material shows a significant slowing of the upgrade cycle. People are holding on to their phones longer, which means the volume you need to justify a $3 trillion valuation just isn't materializing from that primary hardware driver. And if the main trunk of the tree stagnates, how long can the services canopy keep expanding? Especially since that canopy relies entirely on the installed base of that same hardware. And then there's the competition. It's not just Samsung anymore, it's a structural fight over artificial intelligence. Microsoft and Google are defining this new LLM era. NVIDIA is building the infrastructure. If Apple falls behind in AI, they risk seeing that proprietary lock-in just erode. And I think investors will lose patience very, very quickly. So let's drill down into that fundamental balance, services versus hardware deceleration. You emphasize the recurring revenue stream, and it is powerful. Services margins are in the high 70s, which is fantastic compared to the, mid-30s for the iPhone.
Right.
But here's the critical leverage point. That high-margin services revenue still sits on top of the volume of hardware sold. If the growth of the installed base slows to 2 or 3% a year, the services segment has to grow exponentially faster just to maintain even a modest overall revenue growth rate. So the question is, can Apple keep raising subscription prices or finding new services to add 20% growth year over year indefinitely, just to offset stagnant phone division? I believe that dependency on legacy hardware just can't be fully compensated for by services, especially if market share starts to erode.
I see why you prioritize the hardware metrics, but I would argue that your analysis misses the true strategic value of the service margins. The fact that they are in the 70s means every dollar earned from a service is 2 to 3 times more impactful on the bottom line than a dollar from a phone sale. We're seeing a managed transition toward high-margin stability. The key factor isn't how often the user upgrades. The key factor is that the user stays in the orbit. They stay because of the seamless integration. Even if a user upgrades their phone every 4 years instead of 2, they are still paying for iCloud storage, they're still paying for Apple Music, they're still paying that 30% commission. This recurring revenue changes the entire risk profile. It makes Apple the steady train relying on gravitational pull rather than some volatile motorcycle relying on quarterly acceleration. And that guaranteed pull, that unbeatable brand loyalty you mentioned, is the ultimate shock absorber. And speaking of shock absorbers, we have to talk about the massive cash reserves and how they mitigate external risk. I see why you worry about macro volatility, but the sheer size of Apple's cash hoard is, I think, often misunderstood. It's not just a savings account for a rainy day. It funds aggressive, long-term strategic independence. Look at the M-series chip transition. This was an extraordinarily complex, multi-year, multi-billion-dollar bet to move away from Intel, which fundamentally enhanced Apple's control over its own future. This massive, self-funded transformation is only possible because of that cash cushion. The source material shows the M-series chips are beating Intel in performance, and this investment ensures they aren't dependent on external suppliers for their technological core. That level of strategic control is something their competitors just can't replicate.
Okay, but I have to challenge that line of reasoning. I'm not convinced that a massive cash reserve, which is over $160 billion net cash, is an effective shield against structural risk, particularly geopolitical risk. Cash helps you weather a recession or fund R&D, absolutely, but cash cannot buy you immunity from regulatory action or military conflict. The fact remains that Apple is heavily dependent on China, both for manufacturing and for sales. The source is clear. Any systemic conflict, any severe policy change related to trade could hit Apple hard. And for a company of this scale, geopolitical exposure is amplified, not minimized. You can't just buy structural diversification quickly. I mean, they're trying to move some production to India and Vietnam, but those efforts are still a tiny fraction of total output. The transition is just too slow to mitigate the immediate risk hanging over that supply chain.
And furthermore, regarding the M-series and R&D funding, I have to ask, where is the game-changing acquisition or the innovation that proves this cash isn't just inert capital? The proprietary silicon is impressive, sure, but it's still fundamentally driving the same products. When we look to the future, you suggest they're planning something 3 steps ahead like a chess player, but the pace of competition in AI is unprecedented. You have Google, Microsoft, NVIDIA defining the entire LLM infrastructure, the future operating system of the digital world, and they are moving so fast. Apple's traditional approach to AI has been decentralized, privacy-focused, running models on the device itself. That's great for privacy, but the source material suggests this strategy risks limiting the sheer power and speed needed to compete with cloud-based LLMs. If Apple lags here, the stability you cherish is going to turn into stagnation.
Let's re-examine that AI argument through the lens of Apple's core competency, integration. You're focused on the raw horsepower of the large language models, which is a valid point, but Apple's genius has always been in integrating technology seamlessly into the user experience, making it work reliably, privately, consistently. The slow growth we see today might just be the quiet phase before these strategic bets yield results. And those bets are more complex than an LLM race. I mean, consider Vision Pro. It's not just a niche product. It's the platform for spatial computing. It is Apple betting on the next paradigm shift in how we interact with technology, just like the iPhone defined the mobile paradigm. This, combined with deep integration into health tech, ensures the company is building the next revenue wave, not just milking the current one.
And this circles back to the ecosystem. Why is on-device AI integration the smarter long-term play? Because it reinforces the lock-in. A privacy-focused AI that understands my habits better than a competitor's cloud-based model is an enormous selling point. It makes the entire ecosystem more valuable. And you're right, we haven't seen a multi-billion-dollar acquisition, but that's because Apple funds its own disruptive innovation internally, thanks to that cash. They don't need to buy their way into the next era, they build it. That self-reliance is the true indicator of robust corporate health.
While I appreciate the argument for strategic integration, I just have to stress that the margin for error is shrinking. Integration only matters if the underlying technology is competitive. If Google or Microsoft introduces an AI interface that is so vastly superior that it makes the Apple experience feel clunky, that user loyalty you rely on will fracture. We're talking about the largest tech transition since the internet itself. Apple's history shows they move slowly and deliberately, but the AI space demands radical speed. The risk is that when they finally launch their unified, privacy-focused AI, the market will have already moved on, And I just see insufficient evidence right now that Apple is disrupting itself quickly enough to stave off erosion from these foundational AI players.
To conclude my side, I reaffirm that the current trend presents a clear opportunity. It's rooted in a reliable, mature, cash-rich company. The apparent slowdown is a healthy stabilization phase, a controlled reduction of reliance on volatile hardware spikes, which is expertly supported by the foundational strength of high-margin services. The long-term vision and proprietary silicon, spatial computing, and internal AI development ensures that Apple is building the next foundation while enjoying rock-solid profitability today. The company is taking a breath, but its strategic trajectory is robust.
And I'll reiterate the need to treat this price movement not as a pause, but as a serious warning signal. Stability alone does not justify and sustain a $3 trillion market cap in the face of this kind of competitive pressure and geopolitical exposure. The slowing iPhone upgrade cycle, the overwhelming dependency on China, and the relentless speed of AI competition pose significant threats that the immense cash pile just cannot entirely overcome. The vulnerabilities are simply too great to ignore.
What today's trend clearly illuminates is the sheer complexity of evaluating a company of this magnitude as it navigates a necessary technological transition.
Indeed. The material presents both significant opportunity in the form of guaranteed recurring revenue and severe existential pressure points from external forces. The real question is whether Apple's massive inherent strengths can truly outweigh those structural weaknesses. There's certainly much more to analyze as this giant makes its next crucial moves.